So, you are on Eisenbro, Eisengirl, here at McSwamy's ZooMass. So you're taking Accounting 21 and you sit here in Mahar, all alone. See, that's you. You think you have friends? You don't. That's okay. You have Accounting 221. And he's being yelled at you with candy and sometimes money. $10 if you answer a question. Anyone? And you doze off. Well, you might as well just leave. Or you decided to take the other option, not sitting in class. Instead, you go online, watch Netflix, watch lecture videos, and do whatever else you do online. We won't ask. But really, will the people who don't go to class really watch videos online? Quote, our dearest professor. Basically, in the end, lazy people gonna suffer. But what if I don't care about accounting? All those dreams of being king of a club, treasurer, money man, or woman? Gone. Not happening. Your dreams of being part of SGA to fix the university's finances? Gone. Like, treasurers need accounting, and like SGA totally has power, but whatever. Here's your note page. Empty, because you don't actually know what to write down. And you're probably not paying attention anyways. But you hear debits and credits, and you figure, why not write something down? Okay, debits and credits and assets and liabilities plus something or another. Let's just Google it. First page of Google. Boom. There it is. Assets equals liabilities plus owner's equity. There are debits, there are credits. This is good. Hey, they equal each other. A plus and a minus. That makes sense. Are they matching? Do debits equal credits? Is this a matching principle? Is it a matching principle? No. No, it is not. Matching. Debits do not equal credits. This is not matching. I repeat, debits do not equal credits. Not matching. Debits equal credits is not matching. Is not. What is matching anyways? Matching. You hear it whispered in the classroom. What does it really mean? It's pretty simple. It's when revenue equals expense. That's it. They match. They're the same. Revenue equals expenses. Really important to keep track of, and basically just don't break that rule, because if you don't break that rule, well, you know. Anyway, we know revenue equals expenses, but what does that mean? Does that mean that we take our cash flow and count what's going in, take what's going out, and be happy? No, wrong. Firms actually use accrual accounting. This means it doesn't matter what is happening with the cash. They acknowledge revenue expenses as they occur. Where is this reflected? The income statement. Single-step income statements, those are the easiest. Look how simple that is. They also have multi-step income statements. Those are a little more complicated. Look at those extra numbers. And then there's this 10K. No one really understands it. All right. Enough theoreticals. Those will put you to sleep faster than the baby in their mother's arms listening to Mozart. All right, let's go on to tangibles. That's you. You have a warehouse. This is your warehouse. You can buy things, you can sell them. Well, for the sake of keeping track, we actually just expense things. So look, it's ramen. You buy 12 packs of ramen. This is expensive ramen, so it's $5 for the 12 equals 60. That's great. Total inventory. You buy more. This stuff isn't on sale, so this was $10 for the 12, 120. All right, now we have a total cost. So what happens when we try to sell it? We're trying to sell it over there. Okay, it's going bye-bye. So how much should we sell it for? Well, 6 of it for 5 or 10. Well, if we sell it for 5, that was the first one in, it's the first one out, so that's FIFO. Let's say we sell it for 10, that was the last one in, and it's the first one out, so that must be LIFO. Look.
And why does FIFO versus LIFO matter? Well, inflation. As money becomes less valuable, you now need $10 to buy ramen, not just 5. The cost of things goes up. When things are becoming more expensive, LIFO shows a higher cost of goods sold and a lower revenue. So LIFO, not so happy. FIFO has a lower cost of goods sold and a higher revenue. See, it's much happier. So what if you don't want to use LIFO or FIFO? Well, you use weighted average. So you are buying goldfish, and on 3 different days, the price goes up. Bummer. And when expensing it, you want to use something in the middle. You don't want to use $4, you don't want to do $6. So what do? You take the cost of the bags of goldfish, multiply it by the price for the first day, then you do it for the second day, then you do it for the third day. You divide it by all of the bags of goldfish you have, and you get a number. And guess what? Numbers between 4 and 6. Great. Weighted average, not that bad. So that was inventory. Now you have tangibles, things you can touch, like grass, coal, or office supplies. But what about things you can't touch? These are called intangibles. Trademarks, brands, copyright, patents, goodwill, all that fun stuff. You also have contra assets. These are accounts that make assets worth less. So now we know revenue equals expenses, firms like accrual accounting, and we know matching is not debit equals credits. Well, you're sitting in class and you're like, there's OWLs, connects homeworks, lab assignments, FRPs, midterms, smart books. And even though you can check your work, Sometimes you can't, so you're like, awesome, I should have done extra credit, because you're super behind. Yikes. And now it's exam time, and there's a bunch of questions Lowry said would be on there, and they are. Who'd have thought? So April 16th approaches, and you realize that the extra credit video is your only hope. So you add to the hundreds already on YouTube. Great. And that's Crash Course to Accounting 221 with Kelly, Cato, and Trevor.